while financial markets across the Western world were frozen by sudden trading suspensions and aggressive margin increases. A far darker development was unfolding quietly within the global logistics network. The chaos and noise of the trading floor once again pulled attention away from what was really happening at the docks and vaults, as traders stared helplessly at locked screens and disabled buy buttons. Physical metal was being removed in real time. Verified reports from port officials and logistics insiders in both New York and London confirmed that the volume of precious metals moved over the past 48 hours surpasses anything recorded since the Second World War. This was not a slow outflow, it was an overwhelming surge. Bullion banks. Recognizing that continued suppression of paper prices would ultimately destroy their own balance sheets, chose to dump physical holdings to the highest bidder before an official default became unavoidable. That buyer, however, was not based in the United States. Today, the vaults at JFK and Heathrow are described as hollow and silent. The metal did not vanish into thin air, it relocated. To understand why this occurred, one must examine the arbitrage spread, which has expanded to extreme historical levels. For 3 consecutive days, silver traded on the Shanghai Gold Exchange has commanded a premium approaching 18% above the so-called spot price quoted on Western exchanges. In modern high-speed finance, a risk-free margin of that size represents unlimited incentive. This imbalance functions like a financial gravity well. Why would a Swiss refinery sell a silver bar to a New York bank at $67 when the identical bar can be sold in Shanghai for $80? It wouldn't. Capital naturally moves toward the market that offers the greatest reward. China engineered a pricing vacuum, and that vacuum pulled nearly all available floating silver out of the Western financial system in less than a single week. Western institutions attempted to force prices lower. China exploited that weakness to strip inventories. It was a calculated geopolitical maneuver. Now, fragments of official data are emerging, confirming the most alarming suspicions. Exchange inventories are divided into eligible silver, which sits in vaults under private ownership, and registered silver, which is available for contract delivery. According to the most recent figures, registered inventories have fallen to an almost non-existent level. There are now more than 600 paper claims for every single physical ounce remaining in that category. This no longer qualifies as a functioning market. It resembles a crime scene. The application of fractional reserve principles to precious metals has failed by simple mathematics. If even a small percentage of contract holders demand delivery, the exchange will be forced into default. The shelves are empty. The illusion is gone. There is no silver left to deliver. Why is China doing this? And why at this moment? This is not a simple trade decision. It is a calculated survival strategy. Chinese leadership understands that a confrontation over Taiwan or the South China Sea is increasingly likely. Modern warfare is extraordinarily resource-intensive. Hypersonic weapons, guidance systems, fighter aircraft, and autonomous drone swarms all require enormous quantities of silver. Silver is the most electrically conductive metal known. By locking up the global supply, China is doing more than safeguarding national wealth. It is directly restricting the Western military supply chain. When conflict begins, the United States and its allies may find themselves critically short of the materials required to manufacture advanced weapons. This is economic warfare, carefully disguised as routine commodity buying. Military demand is only part of the picture. China's industrial appetite is immense. The Belt and Road Initiative represents the largest infrastructure build-out in human history, driven largely by green technologies. Solar panels, 5G networks, and electric vehicles all depend heavily on silver. China already dominates rare earth refining. Now, it has moved decisively to control silver as well. Chinese planners examined geological trends and production data. They saw global mine output declining while industrial demand continues to surge. They reached a simple conclusion. Whoever controls physical metal will shape the 21st century. This silver is not being stockpiled for resale. It is being acquired for long-term consumption. Once silver crosses into mainland China, it effectively vanishes from the global market for years. Analysts have warned that the London bullion system was overstating its inventories. The use of unallocated accounts allowed the same silver bar to be promised to multiple clients simultaneously. This structure resembles a Ponzi scheme. Chinese buyers, however, do not accept unallocated claims. They insist on fully allocated, segregated, and delivered metal. When China arrived with billions in cash and demanded immediate delivery, the accounting illusion collapsed. Reports are now circulating of a quiet default in London, where large institutions are being offered cash incentives to delay or abandon delivery requests. China rejected those offers. It took possession of the metal, exposing the fragility of the Western banking model. This silver extraction is merely a symptom of a deeper crisis: the decline of the United States dollar as the global reserve currency. For half a century, dollars were held to purchase oil. That system is now breaking. Saudi Arabia has begun accepting alternative settlement currencies. The BRICS nations are actively developing a new currency framework backed by commodities and precious metals. China is selling United States Treasury bonds, weakened by inflation, and exchanging depreciating paper assets for tangible resources. In effect, they are trading Western debt for real wealth, exiting the dollar system before its collapse becomes unavoidable. And they are removing the real assets along with them. When everything finally settles, the West will be left holding stacks of printed paper, while the East controls the resources that power the modern economy. The consequences of this extraction will soon appear in everyday life. The global solar industry depends on silver that is both cheap and readily available. Western climate agendas and net zero commitments are mathematically unachievable without silver. Now that China is stockpiling supply, solar manufacturers across Europe and North America are facing a fight for survival. Production facilities in Germany and the United States are likely to shut down as raw materials run dry. Solar panel prices will surge, pushing green energy beyond the reach of consumers. Governments have mandated a transition to technologies that no longer have sufficient raw materials to be produced. In doing so, they have effectively handed control of the energy future to their primary geopolitical competitor. The shortage is already moving rapidly toward the retail level. The United States Mint has cancelled deliveries to dealers, while the Royal Canadian Mint remains on extended backorder. Private refiners are reporting delays lasting weeks or even months. This is not a temporary supply issue, it is a structural depletion. Premiums on physical coins have separated completely from quoted spot prices. You may see silver trading at $75 on a screen, but attempt to purchase an American Eagle below $100 and it becomes impossible. True price discovery is happening in the real world, not on trading terminals. The physical market is signaling that paper pricing is fiction. China may be the largest buyer, but it is not alone. Russia, isolated from Western finance by sanctions, has been steadily accumulating precious metals to insulate its economy. India, the world's largest cultural consumer of silver, has seen imports surge dramatically throughout 2024 and 2025. In India, silver functions as a form of savings. As the rupee weakens and inflation accelerates, hundreds of millions of people are converting cash into silver jewelry and bullion. This grassroots demand, combined with China's state-driven accumulation, has overwhelmed Western paper markets. The East still recognizes the value of tangible money. The West no longer does. This raises an uncomfortable question. How did leadership allow this outcome? How did regulators permit strategic silver reserves to be transferred abroad? The answer lies in mismanagement and self-interest. Bullion banks were allowed to suppress prices for decades in order to conceal inflation. Artificially low silver prices were used to maintain the illusion of a strong currency. But undervalued silver allowed foreign buyers to acquire strategic resources at minimal cost. National reserves were sacrificed to preserve appearances. The family silver was sold to cover mounting debt. Now the bill has arrived, and the silver is gone. Given the condition of existing vault inventories, a force majeure declaration by the exchanges is no longer a matter of speculation, but timing. Force majeure is a legal provision that releases parties from responsibility when unforeseen events make contract fulfillment impossible. In this case, the silver shortage will be framed as an act of God or a supply chain failure. Contracts will be settled in cash at manipulated prices. This will mark the official death of the paper market. The moment physical delivery is denied, the paper contract collapses to zero while the value of real metal explodes upward. We are only days away from this split. For the financial institutions caught on the wrong side, the crisis is just beginning. Major banks and swap dealers are short billions of ounces. With the physical supply now concentrated in China, there is no metal available to buy back and close those positions. They are exposed, naked short in a market with no liquidity. The outcome is unlimited downside. To prevent a full systemic failure, the Federal Reserve will almost certainly intervene to rescue the bullion banks. That rescue will require the creation of trillions in new currency, further inflating the value of tangible assets. The system is locked in a destructive feedback loop of its own making. As awareness of the Chinese silver drain spreads, panic buying from industrial users will accelerate. Corporations such as Apple, Samsung, and Tesla are staffed by analysts who understand supply chain risk. They see the numbers and recognize that the system is breaking. Just-in-time purchasing will be abandoned in favor of just-in-case hoarding. These firms will attempt to secure multiple years of silver supply to keep production lines operating. when global technology giants compete for a scarce resource. Prices move straight up. Daily price swings of $10 or $20 will become normal. Industrial buyers will push bids to whatever level is required to survive. For years, warnings have been issued about removing silver from the banking system. The message was simple. If you do not physically hold it, you do not truly own it. That message is no longer theoretical. It is now reality. Any unallocated silver held in financial accounts is effectively gone. It was likely leased, rehypothecated, and sold abroad. What remains is only a claim against an insolvent counterparty. The opportunity to convert digital balances into physical wealth has effectively closed. Inventory has vanished. The shipments are already en route. We are watching the emergence of a new monetary order, the era of fiat dominance, from 1971 through 2025, is coming to an end. A system backed by real resources is taking its place. In this new framework, nations will be measured not by their capacity to issue debt, but by their control of gold, silver, energy, and land. China understands this reality. That understanding explains the vault drain. By securing physical assets, China is positioning itself to shape the rules of the next global financial system. The West, burdened by debt and paper derivatives, will be left with little choice but to accept terms set by those who control the metal. When the public finally understands that their currency is losing purchasing power and that bank vaults are effectively empty, social instability becomes unavoidable. We have already witnessed trading halts. Next will come withdrawal restrictions, followed by capital controls. Governments will attempt to trap citizens inside a failing system. The silver market is merely the early warning signal. The disappearance of silver exposes the fragility of the entire financial framework. Panic that began in commodity markets will not remain contained. It will spill into everyday life. This moment represents the last major transfer of wealth. Value is shifting from the impatient to the disciplined, from believers in paper promises to holders of real assets, from the West toward the East. Those who possess physical silver today occupy a new position of power. They hold an asset without counterparty risk, one that remains critical to future technology. Banks attempted to erode personal wealth by suppressing prices. In doing so, they unintentionally created the greatest opportunity of a generation for those who were paying attention. We are now entering an era of scarcity. Prices may appear on screens at $80 or $100, but availability at those levels will be non-existent. Dealers will have nothing left to sell. Mints will shut down. Direct peer-to-peer exchange will become the only functioning market. Buyers will need to locate sellers willing to part with their metal, and those sellers will demand extraordinary compensation. This is the true face of hyperinflation. It is not simply rising prices, it is the absence of goods. Silver itself has not become expensive. The currency has lost its value. The vaults are empty. Cargo ships are already crossing the Pacific. The financial game of musical chairs has ended, and the West has been left standing. China has executed a flawless economic maneuver without firing a single shot. It secured the metal and left behind the debt. The great silver exit is complete. Those holding physical metal should guard it carefully. It is protection. For those who are not, the only option is hope that the system remains intact a little longer.